In our previous video, we reviewed Shiley Engineering, a fast-growing company. Today we will cover a company that hasn't gone anywhere in the last 3 years when Indian markets had a great run. The company is going through one of the worst cycles and maybe at the cyclical bottom. So why are we talking about this company today? I believe the company could benefit from cyclical version of margins. In our channel, we try to analyze the business behind the stocks and we consider buying stocks to be ownership in the company. We go by what Peter Lynch said, know what you own and know why you own it. First of all, the company is operating in a cyclical sector and prices may go down. The markets are quite volatile and we are trying to find companies with value. Today we will cover a small cap company, Globus Spirits Ltd, that is a market leader in Rajasthan in country liquor and Indian made foreign liquor. The company was established in 1993 as a bulk alcohol producer in Haryana and has ventured into other segments and states. The company's share prices have been decreasing over the last 3 years since it made a high in January 2022. Meanwhile, the company's sales quarterly have gone up from 382 crores in September 21 to 637 crores in September 24. And on the other hand, the company's margin have fallen from 22.97% in September 2021 to 4.74% in September 2024. Today we will analyze whether there will be changes to the fortunes of the company. The company has two major segments. The first one is the manufacturing segment and the second one is the consumer segment. As of second quarter, manufacturing segment contributed to around 63% of the company's overall revenue. Under the manufacturing segment, the company is majorly involved in the sale of four key products: sale of extra neutral alcohol or ENA, ethanol, franchisee bottling services, and sale of byproducts like animal food supplements and carbon dioxide. As the company derives the bulk of its revenue from this segment, it would make sense to cover this segment. The company sells ENA to major liquor producing companies like United Spirits Ltd, Beam, Bacardi, Allied Blenders and Radico for the manufacture of whiskey, vodka, brandy, etc. The price of ENA is market driven. In India, ethanol is mainly used for petrol blending. The company sells ethanol to oil marketing companies for blending with petrol. The prices are fixed by OMCs like HPCL, IOCL and BPCL in consultation with government. Sale of animal feed supplements and carbon dioxide are produced as byproducts of the manufacturing process. The company has bottling contracts with United Spirits in the states of Haryana and West Bengal and with Bacardi in West Bengal to manufacture their flagship brands. Ethanol is the most important product which brings in more than 1/3 of the revenue. Therefore, it is important to understand the ethanol economics. This will be one important part of the analysis today. Bulk alcohol sales for the company was 21 crore liters for fiscal year 2024 compared to 18 crore liters in fiscal year 2023. To save valuable foreign exchange and reduce carbon dioxide emissions, the Government of India formulated an ethanol blending policy to blend ethanol with petrol. The decision to blend ethanol with petrol would considerably reduce the trade deficit and save foreign exchange, as 85% of the crude oil required is imported by the country. According to the government estimates of the last 3 years, crude oil substitution of nearly 110 lakh metric tons saved more than 75,000 crores of foreign exchange and reduced net carbon dioxide emissions of around 332 lakh metric tons. Before the amendment of the ethanol blending policy in 2018-19, C-heavy molasses was the primary source of production for ethanol. C-heavy molasses is the byproduct of sugar production, which is also called final molasses, which is left out after the production of sugar. The bulk of India's ethanol production is from sugarcane. The majority of India's sugarcane production happens in 3 states: Uttar Pradesh, Maharashtra and Karnataka. Most of the sugar mills are concentrated in these states. So these states have an ethanol surplus. The ethanol blending policy mandated ethanol blending in all states. As there are significant freight costs involved in transporting ethanol from these surplus states to deficit states, oil marketing companies preferred the procurement of ethanol from each state. During the supply year 2018-19, multiple raw materials such as bee molasses, sugarcane juice, sugar syrup, and damaged food grains like wheat and rice unfit for human consumption were allowed for ethanol production apart from C-heavy molasses. This allowed the company to produce ethanol from grains which was supposed to reduce the cyclicality associated with extra neutral alcohol prices. For this ethanol supply year 2023-24, the government has approved ethanol prices based on feedstock, where the price is 64 rupees per litre for ethanol from damaged food grains, 58.5 rupees from FCI rice, and 71.86 from maize, including the incentive announced. The ENA prices and margins have been very volatile historically. But with the amendment in the ethanol blending policy, many ENA or ethanol surplus states turned into deficit states. And the assured takeoff of ethanol at prefixed prices ensured downside support to ENA prices as well. This gave more opportunities for companies manufacturing ethanol from grains in states where sugarcane was not produced. This worked great for the company until it didn't. The company began expanding into new states and increasing its capacity in existing states. In 2021, the company decided to go on a strategic expansion of its capacity from 500 kiloliters per day to 940 kiloliters per day in 2 to 3 years. This expansion was planned out in ethanol deficit states such as West Bengal, Bihar, Jharkhand, and Haryana. The company produced ENA or ethanol primarily from broken rice. Broken rice is fragments of rice grains that have been broken during milling, drying, etc. These are usually considered inferior quality and priced much lower than regular rice. With the prices of rice falling significantly in 2021 due to an increase in rice production, the company reported great margins, and their operating margins touched 26% in June 2021. On top of that, the most attractive announcement for grain-based distilleries was that surplus rice would be supplied for ethanol manufacturing at 2,250 rupees per quintal by FCI. This ensured the supply of rice at optimum prices and assured offtake at prefix prices, leading to profitability. With this, many companies started expanding ethanol capacities. But things changed when rice prices started increasing and reaching the highest levels since 2008. With this, the prices of broken rice also started increasing. Even though broken rice is mostly used for animal feeds in India, they were in good demands in some of the African countries. The broken rice price surpassed the price of FCI supplied rice. Then the company moved to ethanol production using FCI supplied rice exclusively. There was some increase in power and fuel costs, which also contributed to a reduction in margin. However, the biggest jolt happened to the company when FCI stopped supplying rice for ethanol production in July 2023. This was in response to increasing rice prices. The government also banned the export of rice and broken rice to curtail rising prices. Consequently, the production of ethanol from rice was no longer viable. The company finally had to look at some other sources. As ethanol produced from maize had a higher procurement price, it started using maize as the primary feedstock for the production of ethanol in 2024. The yield of ethanol from maize is lower compared to rice, which affected the overall sales of the company. However, margins were higher on the production of ethanol from maize because it would fetch a higher price of 71.86 per litre, which was 12% more than the price of ethanol produced from rice. To understand the impact of raw material prices, we will take a look at the company's cost of goods. The raw material cost for the last financial year was 69%, of which grain prices alone were 60% of the sales before excise duty. This clearly indicates that raw materials, especially grain prices, plays an important role in the profitability of the company. As we already mentioned, rice prices rose to the highest level in 2023 since 2008. It went up so high that Government of India decided to ban the export of various grades of broken rice and also set minimum export prices on various kinds of rice. As we discussed, FCI stopped the supply of rice for the production of ethanol. This was done to safeguard Indians from exorbitant price shocks. After listening to all this, one would think there is nothing positive about the company. But there is more to this story. Let us come back to the present situation. India benefited from favorable weather leading to a great Kharif paddy season. Total rice production during 2023-24 is estimated at a record 1,378 lakh metric tons. It is higher by 20.70 lakh metric tons than the previous year's rice production of 1,357 lakh metric tons. As per US Agriculture Department data, the production is further expected to increase next year. According to USDA, global rice production in 2024-25 is projected to reach a record 530.4 million tons, up 3.1 million tons from the previous forecast. India accounts for bulk of this upward revision. Production forecasts were also raised for Egypt, Guyana, Japan, and Venezuela, and lowered for the Philippines only. Global supplies include the beginning stocks plus production in 2024-25 are projected at a record 710.3 million tons, up 5.6 million tons from the previous forecast, due to a large carrying and an increased production forecast. Taking the increased production and availability into consideration, India in September 2024 removed the minimum export price for rice for different grades. India has not yet lifted the ban on broken rice. However, India has since allowed limited exports of broken rice to meet the food security needs of other countries. Rice reserves, including unmilled paddy in state granaries, total 44 million metric tons on December 1, 2024, against a government target of 7.6 million tons, as per the data compiled by FCI. With a record stock and production, the rice prices may moderate, which should improve profitability for the company. Most of the capacities, except for their plant in Rajasthan, are fungible, which means they can be used for the production of either ethanol or ENA. In Rajasthan, the company doesn't produce ethanol, it mostly produces ENA for internal purposes to produce its brands. For this purpose, the company uses broken rice, so any fall in rice prices should positively impact the margins. FCI also invited a tender for the supply of rice for ethanol production at 2,873 rupees per quintal in September 2024. However, other than a slight sentiment change, the price doesn't seem to be great for ethanol production. With stockpiles rising to record highs and the government also advancing the rate of 20% ethanol blending from 2030 to 2025, FCI may be forced to reduce the reserve price of the supply of rice for ethanol production, which should aid margins for companies like Globus. Note that the ethanol blending policy is very dear to the government, and they announced that they have made huge foreign exchange savings due to the ethanol blending policy. The company has recently commissioned its bottling plant in Uttar Pradesh. The entire range of production of regular and other brands will be from this plant. Globus is also spending 80 crores for setting up an ENA plant in Uttar Pradesh to reduce the cost in procurement of ENA for producing regular and other brands in UP. The company also plans to complete a malt spirit maturation project for its prestige business at a cost of 30 crores and is also upgrading its plans to improve efficiency of its production of ethanol from maize and also for production of corn oil as a byproduct at its plants at West Bengal, Jharkhand and Bihar at a cumulative cost of 50 crores. These projects are expected to bring in an additional EBITDA of 4 to 5 rupees per litre on ethanol production from maize at the current rates. The consumer segment is currently 32% of the revenues from a peak of 43% in 2022. With the rapid expansion of the manufacturing segment, the overall revenue contribution from the consumer segment has considerably come down. Currently, regular segment contributes to 90% of the revenues and prestige segment contributes to 10% of the revenue. The company reported a revenue of 2,108 million in the last quarter at an EBITDA margin of 16.5%. Within the regular segment, the company has two major products called Value and Value Plus. The Value segment, also called country liquor or Indian made Indian liquor, has a price of 40 to 60 rupees per 180 milliliter. The Value Plus segment, also called Indian made foreign liquor, has a price of 80 to 95 rupees per 180 milliliter. Prestige segment has a price of more than 125 rupees per 180 milliliter. The company has a lot of brands in this segment. In the regular segment, the company has presence in Rajasthan, West Bengal, Haryana, and to a small extent in Delhi as well. The most exciting part of this business is that the company is entering Uttar Pradesh in the country liquor segment towards the end of third quarter this year. In the value segment, UP is a huge market with a sale of 100 million cases, whereas Rajasthan has a market of around 35 million cases. So entering this market should help the company increase its revenues significantly. Revenue from the prestige segment in the current quarter has grown to 240 million, up 270% year on year. Currently, this business is loss making at EBITDA level. The company launched this segment in 2017 with a few brands. Initially, they were launched in a couple of states. Over the years, they have entered 7 states. Those are Delhi, Uttar Pradesh, West Bengal, Rajasthan, Punjab, Haryana, and Goa. As indicated by the company, the EBITDA losses in this segment has already started to come down, which should also aid profitability. The company has no plans to foray into any new states this year. As per the company, some of the brands like Mountain Oak is getting good traction, especially in Uttar Pradesh. The company has launched a lot of brands in the last 1 year, including a single malt whiskey Doab in a limited edition recently and a luxury gin by the name Terai. Globus also has ventured into the ready to drink segment with the launch of Not Out, a strong drink of about 15% alcohol by volume, similar to the Brocode. It is also planning to launch Caddy beer in India by first quarter of FY26. Altogether, the company is trying to get aggressive in the prestige segment. The company is trading at a price earnings ratio of 40 against a median price earnings of 16.5. So, on a PE basis, the company seems to be expensive. However, there is a saying that it is good to buy cyclical companies at high PE. The reason is that during cyclical lows, the earnings of these companies get so depressed that PE seems to be too elevated, even if the prices of the company has come down significantly. Let us now have a look at the risk. One of the major risks to the business is prohibition of liquor. Liquor is banned in Gujarat and Bihar. In 2017, when alcohol was banned in Bihar, the company had to close its facility. The facility was finally reopened after a Supreme Court order allowing them to produce ethanol and extra neutral alcohol from this facility. The chances of prohibition are less considering the large excise revenue it generates. Also, Uttar Pradesh has increased its excise revenue with a good excise policy. The second risk is the ban on Indian made Indian liquor or country liquor in any of the states where Globus has a presence. IML or in country liquor is banned in many South Indian states. The third risk is the increasing debt. The company's debt has increased from 180 crores to 420 crores in the last 3 years, and it may further increase with the capex plant. But the interest outgo seems to be pretty low for the debt it holds. Even though there is interest subvention on some of the term loans the company has, it seems like the company is capitalizing some of the interest. The fourth risk is any reduction in targets for the government's ethanol blending policy could be, in fact, quite negative for the company. If the government takes a different stance on the ethanol blending policy, there will be a large unutilized capacity, which would also pull down the extra neutral alcohol prices. However, as of now, the government seems to be very committed on the ethanol blending program and its forex savings. The government has also raised the blending target for the next year. To conclude, the company has really suffered from the poor margins from manufacturing, from which it derives more than 60% of its revenues. The company went on a rapid expansion spree to capitalize on India government's ethanol blending policy. Even though the company's sales increased, margins nosedived due to raw material price inflation, especially rice. The situation worsened when FCI stopped supplying rice for the production of ethanol. Rice prices touched the highest point since 2008. As with every cyclical industry, we expect cyclical reversion of margins in this industry with robust rice productions. As per the company, every 50 rupee drop per quintal in rice prices will improve the company's EBITDA by 1 rupee per liter. The company did make a sale of 20.8 crore liters of bulk alcohol in the last year. The record production of rice in India indicates softening of rice prices. Another factor to be noted is the record stock with FCI, which could reduce the reserve price now for the supply of rice for ethanol production, considering government's ambitious ethanol policy. In the consumer segment, the company could benefit from entering the quadrilateral market in a 100 million case per year Uttar Pradesh market. Also, the company would benefit from reducing losses in the prestige segment as it breaks even in the first five states where it entered. The main investment thesis here is cyclical margin reversion owing to softening of raw material prices.